Forget oil money. In Texas, the fastest way to become a multimillionaire is by stealing your neighbor's property taxes. In 2 months, a tiny town of 13,000 people in West Texas, Pecos, went from a dormant bank account to over $4 million in the bank. They didn't sell anything. They did it by selling a $1 billion tax loophole to corporate developers in Houston, Dallas, and San Antonio. This is the story of the Great Texas Tax Heist. $300 million in annual lost tax revenue, $2.7 billion in property value wiped clean off local tax rolls in DFW alone. This is the scandal you weren't supposed to hear about. And the bill? It landed right on your property taxes. The scam was brutally simple and financially engineered for maximum profit. Lawmakers closed one loophole for PFCs, and the system immediately did a whack-a-mole. Developers simply jumped to the looser HFC rules. The financial fraud at the core? A developer buys a luxury complex in Dallas. They partner with a distant traveling HFC, like Tarrant County, Maverick, Pleasanton, or Pecos. In exchange for a 6-figure upfront fee, the HFC grants the developer a 99-year full property tax exemption, the largest operating cost for an apartment complex. Eliminating that expense is pure profit. One deal saved a corporation $700,000 annually, a potential $69 million over the life of the exemption. The profit margins here are simply unbelievable. The local community? They got zero revenue impact. These small HFCs were earning fees of around $300,000 per deal, plus a percentage of the developer's annual tax savings. This was a direct financial incentive for tiny governments, often hundreds of miles away, to actively erode the tax base of major Texas cities. They were explicitly created to earn income off distant taxpayers. This tax dodging became their single biggest source of revenue, essentially creating a parasitical financial model, where they were explicitly created to earn income off distant taxpayers. The affordability promised was a sham. One report found properties exempted from millions in taxes only set aside 10% of units for people earning up to $88,000 a year, which is far from deeply affordable housing. While corporate developers celebrated massive long-term tax savings, one California firm was looking at $712 million. Local officials were left completely blindsided, watching their city's financial foundation crumble. They had no idea these deals were happening. No notification, no approval, just sudden multi-million-dollar losses of tax revenue. The local reaction moved from confusion to absolute fury. These cities weren't just losing money, they were losing the ability to fund essential services. For instance, the city of Euless discovered they were losing the equivalent of 2% of their annual income from just one such property. Money that should have gone to their schools and first responders. Williamson County, north of Austin, filed a direct lawsuit against the Tarrant County HFC, obtaining a temporary restraining order to stop deals that were projected to cost their school district alone over $1 million per year in revenue. Tarrant County, a major metro area, is now aggressively challenging nearly $1 billion worth of property exempted through this scheme. This wasn't merely a loophole. It was a clear-cut case of financial harm, which is why local officials called it one of the greatest frauds put on the Texas taxpayers. Breathtaking County alone is challenging nearly $1 billion worth of property exempted through this scheme. I was pissed. I still am. Texas communities shouldn't have their tax revenue stolen by distant agencies cutting back room deals. This was a rigged game. When $2.7 billion disappears from tax rolls, local homeowners and businesses must pay higher property taxes to cover the shortfall. Developers walked away with millions, all for a vague promise of affordable housing that only people making $70,000 a year could even qualify for. The system was rigged against the homeowner. Controlled, setting up the suspense. The media exposed it. CBS News Texas launched a months-long investigation revealing the scale of the financial damage. Mayors and county judges testified, demanding action. But there was one figure, the governor of Texas, who said absolutely nothing while the loophole drained billions. Governor Greg Abbott. No press conferences, no outrage, just complete silence. Synagogue, led by Senator Paul Bettencourt and Representative Gary Gates, saw the writing on the wall. They drafted House Bill 21, determined to close the HFC loophole. The bills moved quickly, passing both chambers with veto-proof majorities. On May 29, 2025, Abbott had no choice but to sign the fix. But the real reason for his silence is even darker. Why did the governor of Texas only act when he had no choice? The answer, tied directly to who funds his campaigns, is coming up. The moment Abbott quietly signed HB 21, the market panicked. For the traveling HFCs, their lucrative business was dead overnight. For developers, it was financial ruin. The new law gave them just 18 months, until January 1, 2027, to get local approval for their exemptions. Houston, Dallas, and Austin said a resounding no. The immediate refusal by local authorities meant the developers were now holding assets with a ticking financial time bomb. HB 21, the legislative fix, introduced massive mandatory changes that were designed to destroy the business model. For any existing exempted property to keep its status after the deadline, it had to comply with new, harsh standards. Developers now had to prove that the rent reductions equaled at least 50% of the value of the tax savings, money they were previously pocketing. Furthermore, they had to agree to accept housing choice vouchers and face new, mandatory annual compliance audits to verify the public benefit. For properties financed on the promise of zero property tax, these new costs meant instant insolvency and guaranteed negative cash flow. This legislative pressure rapidly converted high-value properties into unsellable, toxic assets, because no lender would touch a loan tied to an immediate, massive, and unpredictable tax bill. HB 21 introduced massive, mandatory changes. Developers now had to prove that rent reductions equaled at least 50% of the tax savings. They also had to accept housing choice vouchers and face new, mandatory annual compliance audits to verify the public benefit. For properties financed on the promise of zero property tax, these new costs meant instant insolvency. Properties financed on the promise of zero property tax suddenly owed hundreds of thousands, sometimes millions annually. An expense like $83,000 monthly meant negative cash flow. This is where the story hits your wallet. Lending giants like Freddie Mac had already pressed pause, viewing these properties as toxic assets. No one would refinance. We saw immediate defaults. One Dallas developer lost $40 million in equity and faced bankruptcy. Another investor's 5 properties were thrown into foreclosure. The bill Abbott quietly signed triggered a financial earthquake in the Texas real estate market. This scandal also attracted the attention of federal regulators who oversee housing initiatives. A key finding of the subsequent investigations was the massive gap between the promise of affordable housing and the reality of who actually benefited. Developers used the HFC tax exemption to avoid paying property taxes, but often only reserved a tiny fraction, sometimes less than 10%, of the units for tenants meeting the true definition of low income. The majority of the units were leased at market rates, allowing the developers to pocket the tax savings while the public received minimal benefit. The Department of Housing and Urban Development, HUD, began its own scrutiny of the loophole structure, recognizing that the arrangement effectively subsidized massive corporate profits using the guise of public good, rather than genuinely increasing affordable housing stock for those most in need. The sheer silence of the governor and certain state leaders was not accidental. It was the result of a massive, quiet lobbying campaign. Records show that developers and law firms specializing in HFC deals were significant political donors to the state officials who had the power to stop the loophole sooner. Once HB 21 was filed, The real estate lobby launched an immediate, intense blitz, pouring hundreds of thousands of dollars into campaigns and organizing opposition within the legislature to slow or weaken the bill. This action highlights the deep political entanglement of the scam. The money being saved on property taxes was recycled back into the political system, creating a self-sustaining cycle where the developers funded the campaigns of the very people who were supposed to be regulating them. So, back to the silent governor. Here's why Abbott never led the charge against the theft. Protecting the donors. The massive corporate developers who benefited from the loophole are primary contributors to Abbott's political machine. Protecting the brand. Admitting corporate abuse shatters his "Texas is business-friendly" image. The governing strategy. He waits. He follows. He only acts when forced by media and legislation. He stayed quiet while the loophole drained billions, then quietly signed the fix. House Bill 21 was a victory, but Governor Abbott's silence proves one thing. He protects corporate donors over taxpayers. He only moved when lawmakers and investigative journalists made his inaction politically impossible.